Okay, great. So let me just start. So this whole idea essentially came to me when I was invited to talk at an investor conference in Mumbai, and the investor conference, I think there were about 150 people with a very eclectic mix. People varying from freshers, like we have a lot of them in our group today, and very experienced people also uh, have who have been in the market for, let's say, 20 years plus, and very experienced people. And so when I was thinking about how to present this topic, I essentially was thinking from everybody's point of view. I was not thinking how I construct my portfolio. It was how can I present a framework which can help everybody make a good portfolio, so to speak. Um, so that was the whole idea, and after that, I have presented this at many forums, mostly because many people have told me that this has helped them to give a structure to their whole portfolio construction strategy. So that is the idea of this presentation. But there are few things we're not going to discuss here. Okay. I'm not going to discuss what stage of life you are in and what should you invest in. Personal allocation, various asset classes, all these things I'm not going to go. I'm not doing a personal finance session, so to speak. I'm only concerned about equity portfolio construction. Okay. And mind this word, I'm talking equity portfolio construction and not portfolio management. Can anybody tell me what's the difference between the two? A quick one-word answer. What's the difference between constructing a portfolio and managing the portfolio? Make a new one, okay? Even if you have an old one, that's fine. How to build, okay? Okay, one is selecting the stocks, other is managing. How to pick stock, okay, but I'm not talking picking stocks. I'm just talking portfolio construction versus portfolio management. Now, if I think from my angle, the only difference between the two is the art of selling. And if I don't cover selling, portfolio management is an incomplete art. Okay, so what I'm currently telling you is the construction part of it. I'm not delving into the selling art, because selling is essentially a very unique art to individuals. I can discuss that, but that's not the point. That's not the topic for today's discussion. Okay, so this is how I see portfolio construction. Okay, portfolio construction consists of two things. One, it's a stock selection, and second is allocation decisions. Now, what does that mean? Stock selection is essentially which type of stocks you will choose, okay, and what kind of philosophy you have. And since I'm going from a neutral perspective, the stock selection is a very neutral. I'll take stock selection from a very neutral point of view, not from a fundamental investor's point of view, not from a technical guy, nothing like that. Okay, and the second is allocation decision. Now, choosing in stocks in themselves is of no use. Okay, if you're not able to allocate properly, you might as well not do the work of stock selection at all. Okay, in fact, the Yale Endowment Fund manager, and Yale is the best performing endowment fund. He has very clearly said that for him, stock selection even doesn't matter. He said all my returns essentially are from portfolio allocation, and not portfolio allocation. He's talking more from asset allocation point of view. But I'm just saying that from his point of view, also stock selection is of no use unless and until you have spent good time considering allocation decision. Now, not to confuse you guys, when he's talking about allocation decision, he's talking from a asset allocation point of view, not so asset allocation means how much to real estate, how much to bonds, how much to stocks, and that part. Not in the strictest of sense what I'm talking here. But I'm just trying to give you a parallel. Okay, so don't confuse if you read something about that. Let me do one thing. Let me just. Okay, so this is where my framework starts. A framework for stock selection where I think of it as, let's say, you take a 0% to 100% line, all right? And when even if you're a new person, this framework will work. If you are an experienced person, this framework can still work. Now, what I'm proposing here is that you look your portfolio as 100% or 120, 150 if you are leveraged, but let's stick to 100% scale and divide this portfolio, put a line in between. But the line is dividing two different quotas. One I call investment philosophy quota, and another one which I call a respect quota. All right, and then you start and put a line somewhere. Okay, so what essentially this line will tell, so let's say this line is at 80%, this will say that 80% of my portfolio is investment philosophy quota and 20% is respect quota. Now the question is, what does these two things mean? And what decides where to put this line? Okay, if I have the proper answer to these two questions, I can go ahead and use this framework for my selection. So first is where to keep this dividing line. Okay, now if I have to answer this question, if I have to answer this question, I think the dividing line between the two quotas essentially depend on these two things. What are your conviction levels and what are your long-term goals? Okay, let me go through conviction levels first. Conviction levels essentially. I can see some people talking in between. Guys, if you're on audio, can you just switch off the audios? Okay, slide is not moving. Is slide moving now and audios are clear? I don't know what the problem is.
It's on slide number 6.
Yeah, can you see where to keep the dividing line and conviction levels and long-term goals? Great, so all things are fine now. Right. Yeah, so what I'm doing in between that I go to full PPT because I don't want to disclose everything initially, but in between I just come here to see the comments so that I can, simultaneously. So there is nothing in the third slide. I just said that the dividing line between the quotas is on conviction levels and long-term goals. Don't worry about this thing. I will be discussing all these things in detail anyways. All right. And this was the fourth slide for anybody who wanted to see. Okay, so let me just take you to the conviction levels and how I think about what conviction level means. Okay, it's very easy, and I see many people talking about, if I have the conviction, I'll do this, and if you don't have the conviction, I personally do not give any heed to generic comments without telling, in detail as to what does that mean. Okay, so a lot of people say that I have very high conviction. Now, I want to know what high conviction means. So what does high conviction mean? High conviction means that I can, within my risk assessment, I can bet a lot of money on this particular thing because I have done my work, let's say. Okay, now that work will depend on what kind of investor you are, but I'll go that in detail. So the way I see conviction levels, first, if you don't have an investment philosophy, you cannot have a conviction level. Okay, it's as simple as that. So when you start your careers, there are a lot of freshers in this group. When you start a career, you have no conviction levels. No matter what you say, you go to some senior investor and tell him his idea and say, sir, I have a lot of conviction level. Well, that's really not possible unless and until you really know what you're saying. Okay, so when you're starting your career, essentially you have, well, to say the least, you have zero convictions. Okay, you can have a bit of it, but very close to zero convictions, because you do not have any investment philosophy as yet. Okay, you went to some books, you read about technical analysis, you went to charts, you looked about it, and you said, okay, this makes sense. Okay, then you go to, let's say you picked up Intelligent Investor by Benjamin Graham, and he said something else, and he talks about cash plugins, and then you go and you do some work, and then you come. You don't have a philosophy. You don't understand what everybody is talking about. So you keep on hitting and trying. There's nothing wrong with it. That's the natural progression. But I'm just saying that in the initial phases, there is no philosophy. So if I go back to this slide, if there are zero conviction levels, this line will essentially be close to here, okay, or somewhere here, or maybe even 0%. So essentially, whatever portfolio you are making at that point in time, all you're doing is you are, well, you are either taking ideas from other people or your ideas which are not so refined and you're just putting in there. Okay, that in my judgment doesn't go to investment philosophy quota. It goes to a respect quota. On the contrary, it doesn't even go to respect quota. If you're just looking on CNBC and or some other channel, not to pick out on one channel here, but any news channel and just looking to one expert and whatever he says you buy, or you go to all the blogs and just read the idea and you just buy, well, that is plain copy paste. It is not even a respect quota. So what I mean by respect quota and what I mean by copy pasting, all those things I will make you more clear going forward. Okay. All right. So first thing is your conviction levels will be decided by your investment philosophy. If you have one, you can have some conviction. If you don't have one, well, there is no point. Second is the experience part. The more experienced you are, the more conviction you can develop. Now, let me be very clear what I mean when I say experience. I am not talking number of years in the market. On the contrary, I'm talking about number of effective hours you have spent on learning the art. Okay. I think everyone here have met people who are pretty young in their careers, but they have extremely good understanding of subject. And I'm also convinced that you have met people who are very, very senior in the industry and have very little understanding of what they are saying. Okay, so they may have a number of years as experience, but I would hardly call it experience when it comes to. So, I mean, if you spend 20 years not really building the knowledge base, um, that is not going to help you develop conviction levels. Okay, that might help you to say to other people that you have conviction levels, but that is not really going to help you the other way around. Okay, then is the concept of knowledge. Why this is extremely important, especially in this particular era, is because of the huge, let's say, inflow of information. Okay, we are in that so-called information age for quite some time now, and the bombardment of social media is pretty high at this point in time. So what we essentially do in the whole day is we keep on collecting a lot of information. We keep on collecting it. We don't, if you're reading blogs, you have so many to read. You go to one blog, you don't read the blog article fully to appreciate the depth. You just very quickly glance it and then you put it in a to read column. Or sometimes you just bookmark it so that I will read it later. Sometimes you put it in your pocket, in the sense the pocket app, or whatever you do. Okay, so it's not an individual issue, it's the way the information, so much information is available to us to read. So all our days goes into collecting of information, collecting of dots, as I call it. Okay, but we forget to learn to connect the dots. I read an article on capital allocation. I read an article on stock selection. I read how Ralph Wenger would have picked his stocks. But in the whole context, I'm not able to picture as to what exactly, what exactly should I be taking out of all the articles I'm reading. So a lot many respectful people say that you should read a lot, you should read a lot. So people in the initial phases of their life, they spend a lot of time trying to read a lot, but they forget that the quality is more important than quantity. Okay. The third point is the circle of competence. Very, very overly used term, especially after Mr. Buffett have, emphasized on it. But what exactly does it mean? In the initial phases, again, you have pretty much no circle of competence unless and until you are from, let's say, a business family and you have been actively involved in business, and you might understand few things there. But overall, you don't really have too much of circle of competence, so to speak. Okay, and over a period of time, as and when you build your expertise and circle of competence, you keep on expanding it, and hence you can develop more conviction levels. Till the point you don't have it, you don't have enough knowledge to develop the conviction levels. Okay. Now the fourth is control over human biases. It's fair to say that a huge amount of your return, in fact, many people have been very explicit in saying that almost all your returns are, psychological edge and not an informational or analytical edge. Okay. Now, when you are starting off, again, the mind has not really been built up to deal with all the biases you have to deal with when you're practicing the art of stock picking. Okay. So in that sense, you have very little control over your biases. Over a period of time, if you keep on improving, keep on practicing on those things, you have a very good control over your biases, and that in effect have a huge impact on your conviction levels. Okay. And the fifth point is that when you're starting off, you frankly have no idea how to evaluate an idea. Okay, so let's say me and you meet for a coffee and we discuss a particular stock, and I say, okay, you should have a look at this company. It looks pretty good. And you go back home, and that's it. And so if you're starting off, you pretty much have very little way of, a structure as to how you will research a particular company. If you're a technical analyst, you have a difficult fathoming as to what all things I should have considered important to make a judgment call. So as and when you move forward, your process of evaluating an idea becomes very good. In the initial phases when I was studying, it took me 7 days, 10 days, to just get a basic idea about numbers, the quantitative aspects of the company, and then a lot more time to get the qualitative aspect. But over the last 7, 8 years, I have refined my method of evaluating the idea, at least on the quantitative basis, very, very fast. So now I can evaluate a company in like a couple of hours and have a good understanding of it. I'm not saying evaluating like just see the ROE and just see the ROC. No, I'm not talking that. I'm talking the interconnect of all the companies quantitatively. So that process has taken time for me to develop. So now I can still have some conviction in a particular company, but I couldn't have said the same thing when I was just starting off, maybe the first year of my studies or second year of my studies or first year of my practicing or second year. So better evaluation process of an idea also comes, also increase your knowledge base and also increase your conviction levels. So now just very quickly have a look at all these terms. Essentially all these are essentially just telling you that you can have high conviction levels if you do possess these. And if you have high conviction levels, you can allocate more to your investment philosophy. Because and now you can convincingly say that okay, this particular stock, it's there because I want it to be there, because it's my judgment that the stock should be there. So if it fails or if it works, you are the person to be blamed or praised, besides luck, of course. But as an individual, you are the person. Respect quota, on the other hand, is where you are essentially taking a lot of things from outside people. Audio is not clear. Again, okay, so a quick poll, please, if it's not clear to everybody else. Okay, it's clear. Pawan, you have to check something from your end. Okay, okay. Now, okay, I'll try to be slightly slower and um, okay, I'll try to be slightly slower now and also maybe slightly louder. So what is the long-term goal in this whole process? Well, the idea is to, even if you're starting with 100% respect quota, the idea is to reduce this allocation to this respect quota as much as, as much close to zero as possible. Now, I will be discussing respect quota also, but the whole idea is that by the time you are good enough, you should have a huge amount of stock allocation based on your investment philosophy and not on the basis of what other people are saying. Okay, sadly, this is not the case. Sadly, we still eye for 10 subscriptions and experts on TVs and which person is buying what. We'll go to blog which write about, okay, this person has bought this and this person has sold this. Not really our own way of doing things. Okay, but if you evaluate those individuals whom people try to look up to, those individuals have never ever, I mean, you can compare the portfolios and the portfolios will not be same at all. Okay, so Avinash, I am using headphones. Okay. So that's the idea. So the long-term goal is to reduce the allocation to respect quota as much as possible. Now let me take you to the process of selecting stocks on the respect quota. What does that mean? What is respect quota? I've been using this term a number of times. So let me just clarify this. Yeah, so quota essentially means that you're putting few things in few heads, so to speak. So let's say you hold 20 stocks. If out of which 15 you have allocated yourself after your self study according to your own risk and return understanding, your own self understanding, that particular thing is, I'm just calling it a quota just to allot a particular category to that thing. Is that clear, Devidat? Oh yes, it's a virtual thing. There is no please don't sue me for saying anything like quota or something like that. It's purely in a it's purely in a um, framework sense of the word, academic sense of the word. Okay, so let's go to the respect quota thoughts as to what I think about respect quota. What does this mean, and how does it differentiate from the so-called copy-paste quota? Now this is a tricky one because in the initial phase we struggle a lot with it. Okay, so here are my thoughts. My first thought is, when I was thinking about it, I said, why do we even need a respect quota? I mean, that should be the question very clearly. Just because we started with a framework which divides the portfolio into two lines doesn't mean it has to be that way. Okay. So the first question is, why do we need it? And the second is, if we do need it, if I convince you that it is required, what are the smart ways of approaching it? And then later on, I'll tell you how I practice it, if at all I practice it. Okay. So here is it. Why is it required at all? Well, the first thing is that uh, I mean, somehow this is a tendency in human beings to, there's a psychological term for this called FOMO, which is fear of missing out. So somehow we tend to give too much of weightage to what so-called experts are saying, because if we don't do it, we will always keep on thinking, have I missed anything? So your brain works in very mysterious ways, especially when you don't have your own investment philosophy. So imagine yourself as to be a student. What all you do, you go, you read blogs, you want to know what these people are saying, what they are holding, and then you struggle with the whole idea. And if you let that activity go, in the initial phases, you are going to be miserable, so to speak. So your brain works in a way that you want to listen to other people's ideas. Okay? The more senior you get, the more quality of the people you discuss ideas with will change. Okay, but there is always a tendency in your mind to see, okay, I really like this guy. If he's saying something, at least let me listen to it. Okay, even if I won't buy it, I'll listen to it. Okay. The second is what I call acceptance to new ideas. Now, what does that mean? There's this, I told you about circle of competence, right? Now, I see a lot of 22, 24, 25-year-old, starting their careers here in the stock selection, and they talk about circle of competence, and they ignore a company saying that this is not in my circle of competence. This I find to be very funny also and very sad also. Uh, no matter which stage of your life you are in, without doing proper work, without knowing why it is not something you can understand, saying that it is not a part of my circle of competence is a very stupid thing to say. Okay. Now, so let me give you a small example. Almost everybody understands consumer companies. Now, understand means very broadly. You have a sense of consumer companies because you see the products in the markets, you can evaluate them, you have viewpoints on them, you have used them, so you're very comfortable. So I have seen that many people they find themselves at ease when they are evaluating consumer companies, even if they are starting out. But if I ask the same person to evaluate a specialty chemical company, let's say, okay, he will say it's not part of my circle of competence. This is where I get slightly This is where I feel that the whole idea has been taken in a very wrong sense. If you have studied the companies and then you decide that, that's fine. But if you have not studied them and then you decide them, well, that's pure simple stupid. Okay, so when I put a stock in respect quota, essentially I am opening myself to listening to other people's ideas. And if there's something new coming up, I expand my horizon into that idea. I will study that industry, I will study that company, and my circle of competence, so to speak, will expand. So if I have never studied a textile company and somebody comes and say, okay, Garwale wardrobes look good, I will not immediately say, okay, I don't understand textiles. Let me read textiles first. Let me understand if I can understand them, and then I will take that call whether it is, worth my time later on or not. So opportunities comes to open mind, and you expose yourself to new ideas. So that is why I keep a slight amount of respect quota in my portfolio. Okay. And the third big reason, and especially in the initial part of your career, why it is extremely important to have this is to use this as an opportunity to learn from the people you respect, so to speak. So let's say if you like somebody, you understand and you cherish his ideas, it's good to know what he's buying so that you can work on it and you can discuss that stock with him. And once you discuss that, you are far more likely to learn some very tangible aspects of investing than if you don't do this. Okay. I have been guilty of not doing this, so I am telling you, if I would have done this in the initial phase of my career, it would have helped me by, discussing those ideas with the masters, whom I used to consider masters at that point in time. Okay, so why is it required? These are the reasons why I think it is required. Is this clear? Should I move ahead? Well, if circle of competence isn't there, first of all, you should know what this term means. Okay, and in any field, yeah, I agree with you. But in any field, well, I'll be very frank with you. I've studied this subject in itself of developing expertise in any field in quite a detail. But I'll give you a very broad framework. Maybe this will help people also. It was not a part here, but I'll give you a very broad framework. The first step is to pick up a primer on that particular field. Okay, what do I mean? So let's say if I want to learn how to play guitar, the first thing to do is get yourself. I mean, one way is very simple. You take somebody who knows it and hire him. It's the most simple way of doing it, right? But if that's an expensive proposition for you, and that will be if you're not from a wealthy family, or you do not want to use resources for that, whatever reason you don't want to spend money on that. If that is not the way you want to go ahead, the second obvious way is to start building up, get a broad idea about what all things are involved in this particular activity. Okay, and then take one item and then start putting everything in that one item. So if I have to put now into a stock investing concept, and let's say you want to be a value investor or a fundamental investor, you understand first broadly what all things a fundamental investing entails. How will you know that? Well, pick up any good book. Pick up Bruce Greenwald's value investing, or in technical analysis, you can pick up. I wouldn't know too many books there, but or you can read something like a Jack Schwager, which will give you an idea as to what kind of different people exist in the market. So, and then you start building on, you know, uh, you take one thing and start building your expertise in that. So if you've decided fundamental analysis, go ahead and first of all build your expertise in accounting. How will you do that? Repeat the same process. Find one book which will give you the primer, and then go and in detail as to build that. So I mean, so there is a long science to this whole process. If you want, we can discuss it in later. But this is the general way of building your expertise. But one thing is that simultaneously with your reading, make sure that you apply whatever concept you're learning with the actual annual report. So it's a lengthy process with loads of reading. Yes, it is. I mean, in any field. Well, I mean, okay. So let me just divide it in investing terms only. A technical analyst can learn charts very fast. Okay. A fundamental investor, on the other hand, needs a lot of things to be ingrained in himself to be a fundamental investor. But when I say that, I am not implying by the technical analyst has nothing more to learn, because his learning is coming in a direct feedback from the market. he's getting the yes or no instantly, or if he's a short-term guy, and if he's a long-term chart reader, he is still learning a lot of things while practicing. On the contrary, a fundamental investor is doing a lot of theoretical reading first and then applying it. So, but yeah, the learning is a long process. A technical guy will have to read a lot of other stuff, maybe on psychology, more than on fundamental investing. But yeah, that's the general idea. Is that clear? Okay. Now, the way I see it, what are the smart ways of approaching this whole process? So again, when I was thinking as to what should constitute a respect quota, first thing which came to my mind was whom to imitate. I mean, there are so many of them. Whom would you want to imitate? Let me give you a simple exercise if you want it for your own sake. Just even without going to Google, just type the name of all the people you have heard in the market and you have good respect for. Okay, and just make a list even without going to Google. Okay, you will have a list of around 5, 7, 10 people, maybe sometime more also. Every of those guys will have let's say 3, 4 companies which they have discussed in public, and they have said that they will not like these companies. So it's 40, 50 companies, out of which let's say 10 are common. So let's say 30 companies. Okay, and you just buy them. This is a very, very vague way of working on things, for a simple reason that first of all, you will not know which person in itself is, how much of his money is in that particular stock, how much, at what price he bought it, and a lot of other questions which you need to know, for a proper cloning, you will never know. Okay, so the first question was whom to imitate, and this was the broad idea as to what I think about whom to imitate. Now, there are a lot of individuals in the market who are extremely good stock pickers, and then there are a lot of individuals who are extremely good thought process leaders, so to speak. Okay. Generally, again, there is a tendency of human mind. It's a very popularly known bias, is that a person who is able to portray his thoughts clearly is also considered to be a good stock picker, but we clearly understand that this is not the case. Okay, I for myself know many people who I really, really cherish the way they think. Okay, but when it comes to stock picking, that's not the skill they have more of. Okay, so while doing the portfolio allocation, I would probably not want to imitate these people. But yes, for my own understanding, I would want to talk to them, call them, read, their articles or whatever it is. So first of all, differentiate whenever you see an expert. Differentiate as to what do you want to imitate from him. Do you want to imitate a thought process imitation, or you want to do a stock selection imitation? And you can decide to do both. I'm not saying that it's mutually exclusive, but generally we tend to confuse between the two. So my idea here is to, whenever you're deciding, just be pretty sure as to what you are admiring about that person. Okay. The second is, if you are copying somebody, if you have to imitate the best ideas, so don't go by, let's say if somebody says that, okay, I have these 10 stocks. Okay. Now, if you really have to imitate that person, take few of his best ideas, not the mediocre ones. Now, what do I say when I say best idea? Well, the best idea is not the one which he's been talking about, or which is recent idea. Recency doesn't mean the best idea. The best idea is very simply the one where he has put most of his money. Okay. The moment I put this as a proposition, you will have a lot of people you will have to forego. There are many people who you cannot at all ever know what their allocations are to the stocks. Okay, that in itself should be your first filtering criteria. If you cannot know what money is being put into that particular idea, you're better off not listening to the ideas at the first place. Okay, so let's say if a Prashant Chen comes and talks about Sangvi movers, go and see in the HDFC portfolio as to how much allocation is there to Sangvi movers. I'm just giving you an example. No onus on the stock names here. And just as a disclosure, I'm not a registered analyst also, so whatever I say, please take it with a huge pinch of salt. So, so here is the idea. So whenever you can't answer that question, that what is the best idea, it's stupid to copy it. Maybe that idea is 1% of his overall portfolio. Okay, what are you going to really put up so much money on that? Well, for him, it doesn't really matter. Or for any expert you're following, it doesn't really matter if that idea doesn't work. Okay, so till the point you cannot know the allocations, don't try to imitate. Learn from that guy other things, but don't copy his portfolio. Second is that be absolutely aware of the levels, buying levels of the investor. Okay. Generally, most of the very senior investors, they come and talk about stocks in public when they're already multi-baggers for them. Okay, and then we talk about them, and then we try to buy them, and we try to make a hoopla about it. But the whole fact is that you are getting the idea um, pretty late. And if that is not the case, can you tell whether the idea is, even if you know the buying levels, can you know how much allocation has been given to this idea? So both the things are very important, price as well as the allocation. And the third thing, while doing this respect quota, you have to keep in mind is that everyone is fallible. So, so your risk management has to be very, very good. So let's say you are able to find out the buying levels of a person, and you also know, okay, this person is given, let's say 30% to this particular stock. Okay. So let's say you know a very good investor, very popular, very rich, let's say, and you say, okay, this guy has bought this XYZ company at let's say 100 rupees, and he has put 30% of his portfolio, and you have the privilege of knowing this. And then the stock market correction happens, just like it has happened very recently, and the company is available at 80 rupees. Now you will say, okay, this guy bought 100 rupees, 30%, why can't I buy 50% at 80 rupees? Well, you can't, because no one is infallible. And maybe now you know that he has 30%, you will probably not know when he will sell. And you will probably not know when he's changing his calls. So unless and until you have that kind of a repo, it's stupid to put too much of money into into ideas which you're just taking for the respect matter. Okay, so the moment I put this into picture, it's very clear that you cannot take people in respect quota whose portfolio you cannot really have an idea about. Okay, my simple rule, my thumb rule is that if I can't talk to a person on a very regular basis, he is never going to be part of my respect quota. Okay, so so hypothetically, let's say if I cannot call, give me one good name. Okay, the most popular one. Let's say if I cannot talk to Mr. Jinwala on a daily basis, well, I'm not going to consider what company he is buying. Okay, because I don't have any way to know how much of allocation has been done to that particular idea. Is that clear? Okay, so there is a but. Tell me, Nima. Okay, let me guess the question. If you're saying that in the initial phases you will never have a person like that, I'll have answer to that. So wait, if that's the question. Yeah, I understood that question before you wrote it, so I know where it's coming from. I'll come to that. I'll come to this point. Any other question? Okay, so let me just first cover this question. And now it's a very common, it's a commonsensical point, right? In the very starting, neither you have people who will, you will converse at, and especially the experts, nor you have people who you can, even if so there are people who you can talk to regular basis, but probably they're not that good. And second thing can be that you're trying to copy people who you will never get an idea about their portfolios. Okay. Now there are two solutions to it. First, my simple suggestion, and let me be very blunt with it, unless and until, so if you want to sit at home and you want to get all the ideas and make a very intelligent respect quota, well, that's not going to happen. Okay, so the way to do this is to work on the two aspects parallelly. First aspect is to build a rapport with people who you think are good and who can guide you in these kind of stuff. The rapport is built not by sitting at home, but being part of many, various conferences, various meetings, especially nowadays when there is so much of, public attraction to all these events. My suggestion to all of you is to be actively participative in all these things. And secondly, it's always best to work something and then try to make reputation with senior people than to do the other way around. Okay, so in the absolute initial phase, even though you're trying to build that respect angle, people you, first of all, in the initial phase, you will never know who to respect anyways. Okay, so spend your time in both the things, learn about the concepts as well as learn about the companies which people are buying, and do your homework to build that reputation. Otherwise, it's just a pure simple, I mean, no, nothing comes on a silver, just sitting on the plate. So you have to work for that part. Secondly, in the initial phases, the only available ideas to you are the one which are uh, listed PMSs or mutual fund companies. Now I know that a lot of people say that once the mutual fund buy, anyways the whole story is over. Well, that's right, but you also have to. I mean, it's for a small cap investor that pretty much is the case. But you also have to understand that most of the good mutual funds, um, especially run by good people, even within their constraints of not being able to buy large cap, small cap companies, they do try to buy good companies at a time where they feel they can really easily compound money. Okay, and if they have put 10%, 15%, maybe the idea is good. So I'll give you a simple example. Let's say, again, I'm not trying to sell any particular PMS or anything. I'm just giving you examples here. So let's say you admire Ramdev Agrawal and you said, okay, I want to see Motilal Oswal's PMS Holdings, or HDFC, Prashant Jain's, the HDFC Top 200, and whatever the fund name is. So you go through the allocations and go through the companies. There you will pretty much very frequently know what is changing and what they're buying, what they're selling. Now I'll tell you why people in initial phases face the problem. They face the problem because first of all they don't do this activity continuously. They try it, and then they try something else, then they try something else, and what they tried initially they leave it, and by the time they have tried 12 things but they've never stick to anything, and then they say that it doesn't work. Well, trust me, that's not the case. I mean, um, I'm pretty sure there are people here in this group which has done that and who feel that those kind of things doesn't work. But in the initial phases, there is no other way, if I have to be as honest as possible, except for work, mix up, talk to a lot of people in the industry to build that angle, and simultaneously a lot of homework in the sense of understanding of the concepts. Anyways, in the initial phases, where if you don't know stuff, you should not be invested in stocks. You should be learning about how to do it. Am I able to give some clarity on this? Other people? Great. Okay. So now I go to the next part, which is, so as of now, what I've done, I started with portfolio construction, two aspects of it: stock selection and allocation decisions. And within stock selection, I have covered the respect quota part. Now I'm going to cover the stock selection under investment philosophy quota. First of all, why is investment philosophy quota required at all? Okay, so I think I have done enough broad explanation for you to take some ventures to take some educated guesses. What do you think? Why do you think it's required at all? A quick, like, one liner, not more than that, please. Is the question clear, or is so no answer means no answer? or you're contemplating. This will help to take right decisions, okay, to develop conviction, okay, to learn from previous mistakes, okay. Start things, doing investment based on one's own conviction, understanding. Yeah, that's a pretty decent idea. So the whole idea is that if you don't have it, independent. That's the best answer I can probably think of. If you don't have it, the only other option for you is to either not invest or invest blindly, or if you know somebody, just copy paste the same guy completely. But be sure that if you're doing that, you have absolutely no control over your investment portfolio. Okay, so the whole idea is to have enough control over enough control. Now, whether the control is important or not, that's a question which you have to answer yourself. There are many people I know who are better off not having any control over the portfolio. So those people choose to do the other sensible thing, which is to give their money to people who can control it well. Okay, either in form of PMSs or in form of mutual funds, whatever way you consider it to be good. Okay, but that's the other sensible thing to do. But the third kind of people who want to do it themselves, but simultaneously they also don't want to work, and they try to do a mix of a respect quota and a copy paste quota. That's a recipe for disaster. It is always not possible to find out portfolio of the individual whom we intend to. Absolutely right. That is one absolute big reason as to why we should have an investment philosophy. Okay. The biggest problem is if it is 100% respect quota, there is a big limitation of cloning, and the biggest limitation, as Rakesh has said there, is that it is not possible to find out the portfolio of the individual whom we intend to follow. We might find a couple of stocks, we might even get the best stocks, but we can never follow the complete portfolios in their entirety. Okay, and then you can never know when the person is changing the positions. Even if you're following a big fund, the positions you will get to know only at the end of the quarter. Okay, so what's happening in that quarter? If you're following individuals, let's say you know a very popular name, let's say you follow Dolly Khannas of the world, or you know whatever name find your fancies. You you cannot know unless and until you know people are going through the quarterly filings. So the unless and until you know the block deals are there. So I think people have got my point here. So you will never know when they're buying and selling. So what's the point? I mean, this is a wild goose hunt. You can keep on doing this. It's a fascinating idea, but it's not something which is
Hi guys, this is Abhijit here. Yeah, all of a sudden I think we lost Puneet there. Let me quickly check with him. Just hang on. I hope you can hear me. All right, just hang on. Let me quickly check with Puneet.
I can.
Yeah,
You guys
you're
can't
back.
hear me?
Yeah, just for a few minutes, seconds actually, Puneet. We couldn't. We lost you. Now we can hear you fine.
Okay.
Please go ahead. Thank you.
Okay. I don't know what happened. Okay. So, I'm being very frank here, but I think people got the idea. It may be fascinating. It may be a good way to keep yourself busy. It might give you that a topic to talk about in the next in your WhatsApp groups. But essentially, it is not adding anything to you by talking about what the other person is buying and all those. If you're a journalist, it serves your purpose, fine, but it doesn't serve any other purpose. All right. So this is a line which I got from somewhere, and I really love the line. So if you don't stand for something, you'll fall for everything. And this is essentially what happens to people who do not develop their own investment philosophy. You don't have investment philosophy to stand on, so you fall for every next thing that comes to your door. Okay, somebody who is a gram investor, he'll come and say, okay, this is a cash bargain. The company has more cash on its balance sheet than the market cap of the company, and what a cheap way to buy a company. And you will buy that. Then somebody will come and he say he has this much land. That's a very common investment thesis that the company has so much land, and the value of the land itself is more than the market cap of the company or the EV of the company, and you will say, okay, let's buy it. It makes sense. But essentially what you're doing is, since you don't know what to question, you just fall for the ideas. The next one will come and say this company will have this growth and that growth and whatnot. Okay, so if you're following Twitters and if you're following media, one person will say that buying quality at reasonable price is the best way. The other person will say that, and I think most of you will relate to what I'm saying, and I won't name the person, but another person will say that I only buy bad management companies and I make money. I don't know what people talk about. So fair enough, and everybody has their own philosophy, but that person is talking his philosophy, the other person is talking his philosophy, and we don't want to be a dustbin for philosophies. Okay, so uh, it's pretty much a waste if you don't have your own. Yeah, Rakesh, land aspect has been going on for many companies for a long time, and I I, I sometime back wrote an article as to uh, the whole idea of this article was to talk about these kind of companies. Um, it was titled as "Sheep in Wolf's Clothing" or something like that, or "Wolf in Sheep Clothing," something like that. So if you want to read, it's on my site also. It's stoicinvesting.com. So let me take it forward. Now, type of philosophies. I think everyone here knows a lot about this, so I'll take it very fast. Or should I take it slow? I'm just going to talk about what these philosophies are. Very, very simple. Okay, no details. Great. Nima, you have been from mutual fund industry, so I'm sure you're tired of listening to these things. But so yeah, let me take it to very fast. Yeah. So a value-driven philosophy is very simple. The central idea is that the price and the value, they differ. Okay, the price you see on a stock ticker and the price you can buy it and sell it on is not the same as what the value of this whole particular stock or company is. Okay, so the basic premise is that market is inefficient and market participants are biased, so the prices can never reflect the true value. Okay, the only difference is within the sect of value investors, there are subsects as to one will be growth at reasonable price, one is cash bargain, whatever. One is statistically cheap stocks. The only difference in their views is how quickly and how fastly the market is inefficient, and how badly the market is inefficient as to the quantum of the inefficiencies. Okay, so everybody have a different view on that, but basic idea is this: inefficient markets, price different than value, buy when price is far less than the value. Okay, so this involves doing a lot of bottom-up analysis. I think you know all this thing, and then there is a top-down analysis, top-down approach also. Then there is this price-driven philosophy. Okay, so where the price is considered to be a demand and supply and product. So you say that, okay, whatever it is, this is it, and we'll take our decision on this. So the basis of your study is price movements. So if your basis of study is price movement and volumes and all the other related stuff, you are essentially implying that there is no more to it than the prices. Okay, this field is called the technical analysis. Within this also there are many types of technical analysis. There are Elliott wave theorists, there are market profilers, there are trend followers, swing traders, algorithmic trading, so on and so forth. I mean, you can fill up the list with many types. Okay. Now my question is, and since I am dealing with all kind of, in the audience, all kind of people who have very little or very these kind of very basic questions also. The first question is, yeah, so when they say Bhav Bhagwan Che, essentially they mean that the price is God. So value is not even a concern there. When they say price, that means technical analysis. That means, yeah. Great. So my question is which one to choose. Okay. Now this is perfect statement. I realized the technical analysis didn't work. When I turned the chart upside down, I didn't get a definite answer. Okay, I think that's the most funniest explanation I have heard about why technical analysis doesn't work. Okay, and then it comes from Warren Buffett. So who in right mind can say that, okay, this is not true? Anybody who disagree? And if the answer is yes, then probably you are a technical analyst anyways. Then there is this guy. I don't know how many of you know him. At Quota, he says fundamentals that you really read about are typically useless as the market has already discounted them. He calls them fundamentals. Okay. Now let me give you a brief idea about the records. Buffett record, as everyone knows, is extensive, over 30 plus years, over 20 plus CAGR, and considered to be the most awesome record ever. Which is factually, though it is not true. I mean, for people who don't know this, factually, the record of, I think, if I'm not wrong, you can check also, but I think Carl Icahn has a far better record than Buffett. If not far, I think number of years also and percentages also. But that's a topic for something else. So yeah, so this is the way. He says, and Quota has given a 65% or 64% CAGR for some 15 years, which is a good enough number. So my question to anybody who says this, that okay, he is only 15 years and or 14 years and 64%, and Buffett is 30 years and 20%, I frankly don't know which one to choose. I am okay with both. I'm happy with both. And I think the same goes for everybody else. Okay, I will be happy if I have 64% for 14 years also. And that's a good way to go about it. So whom do I listen to? Then there are these people also. You know, William O'Neill, Bruce Kovner, these people say that, okay, you know, just like a doctor will not take a call without taking x-rays and EKGs, similarly, investors should look at charts as a way to diagnose it. Okay, so they use both fixed technicals and fundamentals. Now, just because they use it doesn't make it. But I heard that following both is disaster. Yeah, so there we have the fourth view, that if you try to follow both, so I'll probably use David Datta's quote next time in this PPT, that following both is a disaster. So that's my whole point is, when you're starting off, who do you follow? Unfortunately, our decision of who we follow is mostly an accident than a choice. Okay, mostly your careers are decided by the first person who has taught you. Mostly the subject you choose is decided by the first book you pick to read. Okay, and unfortunately later on we start building our expertise on that particular thing, and then we go on and go. Then we spend 5 years on technical analysis, and then we go on and because after you spend so many years on a particular thing, it becomes extremely difficult for you to acknowledge that okay, maybe I'm wrong or maybe something else works. It's extremely difficult. So what we call in psychology as commitment bias. Okay, so which one to follow? Well, I don't know, but the whole point is that you have to follow something in this particular. So when I'm converting investment philosophy quota, I'm saying that philosophy is something I can never decide for you. Nobody can decide for you. Okay. Again, I recently wrote an article called "Wait, Don't Read Warren Buffett Letters." This was the title of the article, and in that I explained as to the whole problem individual investors face in the starting phases. Best way is to go through various profiles and then see what strikes you the most. For some people, this whole idea of going through annual reports looks like a waste of time. For some people, this is the most sensible thing they've ever heard in their lives. Okay, so find that answer yourself. Nobody can do it for you. The second suggestion which I have here is that the success or failure should be decided in the long term. Now, when I say long term, I'm not saying 30 years. So, I mean, let me make it very clear here. When I say long term, I'm just saying that give it some time. Don't decide it in weeks. And this is precisely what people do when they are in the starting phases, because they are in a hurry. They want to know things very fast. So they will try something new. They will try a cash bargain. They will buy this cash bargain, and the cash bargain, unfortunately, will not start acting as per their command. So in 1 week they'll say, oh, this doesn't work, and then they will go back and say, okay, let me try growth companies. So don't fall for that fallacy. Give it at least a couple of years. Okay, and the best way without wasting time is to do a lot of backtesting. Now I understand that for people who are not very tech savvy, and I am one of them, backtesting is not something which comes very easy. Okay, learning the tools to do that, resources to do that. It's a pretty, so that is why I don't suggest it. If you can do it, it's good. If you can't do it, if you don't have the databases, well, at least then you have to learn from your own experiences. There are only two ways of doing this. Okay. My suggestion again is that if you guys stay anywhere where there's a good library or a good college, they generally provide library memberships to outsiders, and they also have databases with them. Okay, so go and give this a shot. If you guys stay in Bombay, let's say, so you can go to Nasi Munjis of the world, Nespi Jains or NITIs or IIT Bombay or whatever college which provides an MBA course. Navi Mumbai, I'm not so sure. So I have stayed in South Bombay for like 4 5 years, but that's the only area I know. Um, yeah. So I mean, if you're in, so good thing is that there are so many colleges in our country. Srika, what is backtesting? Essentially, you develop a strategy. So let's say you say, okay, I will buy cash bargains, and then you go back in time and you work out if I would have bought this cash bargain, how it would have performed over the period of time. Okay, or the portfolio made of this. So a lot of people do a lot of backtesting on very complicated strategies. Okay, so let's say if I would have bought at PE of less than 10 and ROC of greater than 20 and I would have bought all these kind of stocks in let's say 1980, what would have been my return in 1990 and so on and so forth. So these kind of things are called backtesting. Is this clear? Great. The whole idea of the magic formula is also this. He backtested that these thing works. If you don't know magic formula, well, let me not waste everyone's time here. You can go and search it. Very simple formula. That's by Joel Greenblatt. Okay. So, all right. So stock selection part I have covered. Now I have to cover the most difficult and most important part, and that is the allocation decision. Okay. Now, these are the rules which I follow for, respect quota. First is decide your quota beforehand. Okay, decide the quota. So let's say from today onwards, you follow this framework, go back home and say that, okay, I am new or maybe I am just slightly experienced, so let me have 50% of my framework as respect quota. Or you can say, okay, I will have, I am pretty well equipped, so let me only have 20%. Whatever the number is, decide it first. Okay, and then the second rule is diversify a lot. Okay, just diversify. There is no other sensible way of following the respect quota. Okay, so this is how you can go about it. Make a list of the best ideas of people you respect and diversify them. Now, there are a few mathematical constructs which are possible here. One is that let's say you decide 50% is your respect quota. Okay, you go back home, you start making a list. You find, okay, I just have 1% or 2% I know the portfolios of and I can follow them very regularly, and they have only these 5 companies. Okay, so if there are 5 companies you can buy and 50% is your respect quota, are you going to buy 10% of each company? Well, that's disastrous. Okay, so when you have less ideas, don't increase the allocations, you decrease your quota. Okay, on the contrary, if you have many people you can talk to, and so for example where I am currently, I have a large amount of people in the investing circles who I talk to, who have good respect for. Well, I will have many more ideas, but that does not mean that just because I have many more ideas I keep on increasing my quota. I decide my quota first and then I will increase the diversification. I have a lot of ideas, fine, let me put 0.5 in each. Why to put 5%? Okay, so when I have more ideas, I don't increase the quota, I just increase the diversification. If I have less ideas, I don't go on increasing allocation to individual stocks. I just decrease the quota. Now, if your question which is coming to your mind and which should come into your mind at this point in time is that, then what do? I don't have an investment philosophy quota and respect quota I cannot fill. What do I do? Well, my respectful answer to that question is that don't do anything. Start building your investment philosophy. If the solution you have figured out for yourself is to copy paste, try it. I am pretty sure that in the long run you will find it to be losing money for you and not making money for you. Okay, and if not losing, it will not give you the returns which you think you will get out of copy pasting ideas. Okay, I know when I'm telling you this, the chances are that you will try it nonetheless. So personal experience is the best teacher. But my suggestion is don't do that. Wait till the point you develop something. Okay, you will learn from, and your investment philosophy quota. Once you have something, that will keep on improving. That doesn't mean that from the moment you have investment philosophy, you'll start making money. No, but you have at least your own conviction levels. Okay. Allocation rules for investment quota. Well, I cannot say anything here. And I mean, how can I? I cannot know whether you consider where you stand on diversification, concentration, and all those points. Okay. But what I can say here is what my method is. Okay, and then you can see whether it makes sense to you or not. And because I follow a value investing approach to investing, a technical analysis person will never have the same way of looking at things. Okay, so I can tell you my method of portfolio construction. Well, in the stock selection, I have these two things: respect quota and investment philosophy quota. Now, after many years, I have my philosophy in place, so I put 90% into investment philosophy and 10% into respect quota for all the reasons I've told you. Okay, I can very well make this a 100% number, but I don't want to. I want to keep my mind open for other ideas. Okay. So in the respect quota, it's 10%. In investment philosophy, it is within investment philosophy, I further divide my portfolio into two things: stock selection 1 and stock selection 2. Okay. The first one is 75% of my portfolio, and the second one is 15%. Now, this is my 75%. Good companies, reasonable valuations. I sit on cash if the valuations are not reasonable. That's a that's a hard thing to do, and anyone who has done this for last 6-7 months before this crash happened will know that how difficult this thing is to do. So I was close to around 50% in cash. I think from April onwards or maybe May onwards, I'm not sure exact month, but it was 6-7 months before the market capitulated slightly. Okay, so sitting on cash is a difficult thing to do. I'm not suggesting that's the best thing to do for everybody, but if the valuation is not reasonable, I generally tend to go on cash, and I'm market cap agnostic. Especially in the last year when the markets were extremely expensive in the small cap and mid cap space, I was more towards the large caps than in small cap and mid caps. So, but having said that, that doesn't mean that I don't, I immediately sell, the moment I think it's becoming expensive, because that's not how the markets work. But again, that's my philosophy. I'll share something like that on a different forum if at all possible, or maybe on a longer time frame. But this is the basic idea. Now, I think there are only two things which require explanation. First is, what are good companies? So for me, my good companies discussion comes from these three things. The first thing is, I generally, unlike many other people, I don't start from qualitative factors like, okay, what a great management. I met him and I really was impressed. Let me study the company. That is not my style of working. I know people have that style, but that's not my style of working. I don't go to a market and start doing qualitative study first. My initial level of scanning happens from quantitative numbers. Now, the quantitative scanning doesn't mean, and I will make it very clear, a lot of people feel that if you follow the numbers, you cannot find turnaround companies and you cannot find, good the okay companies which are becoming great companies. Well, that's a myth. I really feel that people who know how to read numbers, they can figure out turnaround. They can figure out those kind of companies where the companies which are ordinary and they're becoming very good. So quantitative scanning is my way of going about companies. Once I zero down to the companies I want to study, then I do a qualitative study. Okay, and then I do follow the checklist method, which has been, proposed by many, so I am again not going to the detail of checklist making. This in itself requires a complete, an hour or 1.5 hour session altogether. But I have a very exhaustive checklist. Then another myth which people have is that if you have an exhaustive checklist, you can never invest. There is a paralysis by analysis kind of stuff. So when they say exhaustive checklist, it's a very stupid way of thinking that, okay, I sit with a huge, like say, a pile of a file, and then I go by one, and then I tick mark and I do all this stuff. Well, that's not how it works. It's easy to imagine when you have not done it. That's how you imagine it, but that's not how it is. It's a checklist which you have. Most of the points will not be valid for the kind of company you're studying. Okay, but you don't want to miss the point anyway, so you very fastly see, okay, this point is not there, it's not valid, so you just move on. It's not something which it's not that painful an exercise which it seems to be. Okay, so for example, I'll give you a very quick example. Let's say a point in my checklist is whether the company buys airplanes. Okay, or it came because I was studying one company where the company bought an aircraft out of the cash they got out, by selling a particular small business. Okay, let me not name the company because it has been a multi-bagger in the last 2 years. But that's a point in my checklist. Now, it's not that uh, and similarly, there are many more points like that. Now, that doesn't mean that when I sit, I will take so much time to go through this because I'm going through the fixed assets number. I pretty much have an idea anyways. It's just that if I don't have the checklist, I might not remember to see all those things. So that's the idea of the checklist. Okay. So whoever has told you that uh, it leads to paralysis by analysis, well, he doesn't really follow it well. I can just say that. So that's the idea of a checklist. Now, this is my second stock selection criteria. I make a 15% portfolio on something I call a Bugsy portfolio. Anybody know who Bugsy Siegel is? This guy? Okay. Amok, is that the answer to the first question or the second as to what he looks like? Trying to be, okay, cool, okay. So yes, Amok, you're right. He actually was an American mobster. Oh no, it's not. It's not me, and I have no fascination for cigars. Plus, I'm not that good looking. So yeah, so it was Mafia Don. Okay, fine. Yeah, so he was essentially Bugsy Siegel is the guy who was a mob guy, but who also was a very fascinating character in himself. He was the one who stood in the middle of desert and said that I'm going to create a big city out of this, and that city nowadays is called Las Vegas. So, and he was the first guy to even think about that as a possibility, standing in the middle of desert. And the first casino was also built by him there. If you have ever been to Las Vegas, there is a casino called Flamingo. It's very popular. If you see a lot of movies on casinos, they show that Flamingo signboard, which is very popular. So he was the guy who single-handedly stood there and it was by accident. He was just passing that area and he just stood there for a couple of seconds and he stuck with this idea. Okay. Now, what I'm saying here is that when I say 15% to Bugsy portfolio, what I'm trying to tell you is that don't. Okay, I'm not. First of all, let me be very clear. I'm not saying that buy companies whose promoters are like this. Okay, uh, don't quote me anywhere saying that. Okay, somebody told me that buy companies which are like Bugsy's. Not really. What I am saying is that the business model of these companies are like Bugsy's. Okay, if they really hit out, they hit really well. Something like a Las Vegas. But if they don't hit out, well, it's a dud. Okay, and clarify, just to clarify, it was he was actually killed before he could see the finalization of the finalization of the casino he was building. But he led the idea, and then the city became the city what it is today. Okay, so the whole idea is that if it works, it should work wonders. But if it doesn't work, it should not take you along with it. Okay, and that is why my rules of allocation are very different for Bugsy portfolios. Okay, but it's a very enticing exercise for me to find such companies where the possibility of upside is extremely huge because of their business models. Okay. Now in Buxy stocks, since the nature of business is very new or very different, it's very difficult to grasp the business. So there, understanding the jockey or understanding the management is an extremely important point. I'll cover Nikhil examples. Okay. Let me cover the concept first. So jockey is extremely important. The business is Buxy in nature. Okay, let me give you an example here. I was studying this company. I'm not saying this company is a part of my portfolio. So again, because I'm not a research analyst and I may not be holding that company at all. But I was studying this company called Ramco Systems. Okay. Now this company is into cloud computing. Now the story of cloud is very long for this company, but I'm just saying that its company is in cloud computing. I have no understanding of the business, and I know many cloud computing people who cannot really, with a great detail, expand the business possibilities. But I've been studying on the business expansion possibilities, and there's a huge upside possible. But also there's a huge downside possible. So how do I so there's a lot of asymmetric payoff. Now they have businesses which are besides that, which gives a support to the company. But if the other part of the business works really well, it can be a great thing. So it's an example. It can be anything. Just similarly, companies like agrotech, they have great everything else, but the possibility of upside is very huge if one or two products really hit out. Okay, so companies like this, but the companies in these companies, the downside should be very low. So that you have to consider. So I'll discuss these in detail if at all possible sometimes. So there you are betting on the management and not on the business model per se. Okay, asymmetric payoffs are there, and the importance of doing scuttlebutt is very high in these kind of companies. You cannot do a lot of annual report reading because first of all you won't get too much of information from annual reports. Is the example clear, Nikhil? Okay. Okay. Great. Now, this part is my respect quota. Okay, my way of looking at respect quota. I have a very small respect quota. I stick to very few stock idea people because so frankly, the more I have been involved in the industry, the lesser the number of people I have respect for in terms of their stock selection. Okay, and voice gone. Hello, is it gone only for Vikas or is it gone for everybody else? Okay, okay. Great. So yeah, so the more time you spend in the industry, the lesser number of people you know have good stock picking skills. There are a lot of people who have good thought processes, and I have lots of such people who I follow for in terms of thought processes. But very few people will come in my stock idea people. Now, the people who I can talk to and I can understand their rationales as well as the allocation decisions, I put them in my quota. Now, see the reason why this is happening. The reason why this is happening is because if I cannot talk to the person and I cannot understand his rationale, well, I'll have a very difficult time taking this company from my respect quota and studying this and trying to make this company my own. Okay, in terms of investment philosophy. So it's very difficult to do this. So I keep it to a very low number. And the third point is probably the most important point. Even though the company in the initial phases goes in my respect quota, it doesn't mean that it's there and that's going to be there ever. Okay, so let's say somebody recommends me a textile company. Even though in the initial phases it will go in my respect quota and I will follow all my rules there, I will try my best to study this company and expand my circle of competence, and I shift this company from this quota to my investment philosophy quota. Okay, so the beauty of this whole framework is that it gives you that flexibility in terms of shifting from taking the companies from one area to another area. Okay, now this is my allocation decision. Stock portfolio one, I follow a 5-8-12 model with averaging down because of conviction. So it's extremely, I think it's a very important page if you want to understand a lot of moving nuances. And we have, I think, 10-15 minutes before we wrap it up. So let me just explain you this page. The stock, so the kind of companies I buy, the more conviction I have, I'm more comfortable buying these companies when the price falls. Okay, since I know since I follow the value investing philosophy, my understanding of value will decide my buying, and so I tend to average down these companies. Okay, 5, 8, 10, 12 model is on the basis of how much conviction I've been able to get on this particular company, and this is for my clients. This is not for my personal portfolio. I'm slightly more aggressive on my personal portfolios, but that's not the topic of discussion here. 5 with 12 model with averaging down because of conviction. 5% is for companies where I have a good amount of understanding, I like the business model and I like the price. Sometimes the same company can go to 8% because of either price or because I spent so much time understanding the company, so now I know it better and I can increase my risk taking in that company. 12 is essentially when everything checks out. Okay, price is good, great things are there in the company. It's a great company in every other way. Now, generally, this kind of thing really doesn't happen that frequently. If you think about it, if the company is all great and hunky-dory, why would it be available at cheap prices? Okay, so generally it's available at cheap prices because at that point in time, something bad is happening with the company. Let's say a company like IPCA, or let's say, uh, name a good company you have in your portfolio which has fallen really well. But pick up one company, no? L&T, okay, I don't follow L&T, but still. So a great company isn't going through troubles. Weber Global, okay, fair enough, okay. So the idea here is that when all the things checks out, I put 12%. I don't go beyond that for a lot of people. Now, Bugsy portfolio, on the other hand, I have allocations of 3 to 5% only, and there are 4 to 5 ideas generally. Okay, but in Bugsy portfolios, I never do averaging down because I am not as convinced on the business models as I am on my other portfolio companies. So, okay, in these companies, uh, a price as well as the results and everything else is a important feedback for me to make a call whether I should load up on this company in future or not. So I do not really, increase my allocations to the companies when they are not being able to realize their potential. Okay, so only when the potential is realized, I do an average up. Okay, and it's an important distinction because a lot of people say you should average down, a lot of people say you should average up. But again, there is nothing cast in stone. You think about the logic of, doing down. Just because you studied from Buffett doesn't mean that you have to follow him to the T. Okay, you have to follow, value investors say that if it falls, you should buy more. And if you are in initial phases, people keep on doing this mistake of putting bad money, putting good money after bad. They have not done their whole work, and then they keep on buying because they think that they are value investors, and it's against what you believe. Okay, so you keep on buying more, and then you lose a lot of money. I'm pretty sure this has happened to some people. It has happened to almost every group I've talked to. There are people in that group who have suffered this problem. Okay, so uh, this is one classic reason why technical analysis says that we cut out the losses and all this stuff. So there are a lot of various viewpoints there. Now in respect quota, I don't put more than 2% in any idea, no matter what. So if I have 4 ideas, my respect quota shrinks to 8%. If I have 20 ideas, my respect quota company's allocation is 0.5% each. Okay. Now you will say, what's the point of putting 0.5%? Well, the whole idea is not to make returns out of these companies. The whole idea is to develop your own understanding of new type of companies and to give benefit of doubt to people you have huge amount of respect for. Does that make sense? Great. So, but at the end of the day, the best portfolio allocation strategy is this. If you can't sleep at night because of your stock market positions, you have gone too far. Okay, so those 5, 8, 12 numbers are for me. For some people, the numbers are 20, 25, 30, maybe. For some people, it is by only 2 companies. For some people, the number is 2%. till the point you are comfortable, nobody else can decide that number for you. Okay, so that's the whole idea of this portfolio construction webinar. I am planning to do a couple of more, not a couple of more, but I'm trying to, take this education mission of ours, so to speak, via webinars to many people. I appreciate what people are also doing. They're doing the same with the same values, and so I'm also planning a special situation webinar coming sometime maybe in next month or so. So I'll be happy to interact with you people. Whatever questions now you have on this thing, you can ask me. Uh, any doubts you have, any questions you have, anything else you want to ask me besides what we have studied today. We have like 5 minutes to close, 7 minutes to close. Okay, any sites to visit for what things, Devidat? Well, you should follow, so Professor Bakshi's blog you should be very frequent with in terms of investment philosophies. Just a second. Okay. Well, I have a huge list. Devidat, I'll do one thing. I'll probably coordinate with these people and we'll put across. Or you can go to my site and there are some blog rows there. I'm not sure if it's visible now, but
I'll just
Rashi,
pitch in here,
I'm not.
Puneet, for just a second. We will be
Yeah.
emailing everyone the link of this webinar. So all of them will receive
Okay.
an email from our end by today. And
Okay.
you can email us a list of books to read or blogs to go through, and we can add it in our email. That will be good.
Sure. So I mean, a lot of things is there on the website, also on the resources page on my site also. I mean, I'm just making those things. I have not yet completed those things. So if you want, you can do that. I'll share some books. As far as technical analysis is concerned, Rashi, I'm not a technical analyst. I do look at charts very rarely and only for more of a learning perspective than anything else. And so, I mean, taking a class on technical analysis is, even though I understand it, it will be very unreasonable on my part. So it's not my forte area. Well, I am a fundamental person. Um, I do tend to look at volumes and I do tend to look at few other things. I don't follow any of the, those, what do you call it, parameters like RSI or something like that. I don't follow all those things. I just look at the volume things sometimes on occasions, nothing more than that. Lastly, as far as basics about FA is concerned, again, my suggestion is that you will find a lot of stuff on my website if at all you want to do that. I don't want to promote it because that's not the idea here. I do intend to take some webinars on basics of FA sometimes. Website address is historicinvesting.com. Maybe I think Abhijit can share also, I'm not sure. I'll write it in the PPT also if you want. How do I decide the holding period for each category of portfolio? Because most of the decisions are based on valuations. If let's say I buy a company with a 5 years view and year like 2013 or 14 comes where your valuations are realized, your expectations are realized in 1 year, well, I get out of the companies the moment I feel they are too aggressive. So holding period is decided on the basis of my study of potential of the companies and the business. But do I hold it for that long? Decided by the price in the markets. Any question I have missed? Share a few books because I'll share the book names with you. Any other question I have missed? I have no inputs on intraday. I don't practice intraday. I have no inputs, Nikhil, on intraday. I mean, I see my interest has always been to look at all the various aspects. So intraday, I do have good friends in the field who follow intraday, and very rare exception are there who makes money. Very few people in intraday makes money. The base rate is against them. Not to have any disrespect for anybody, but that's the long-term Okay, that's what statistics tells us, that not many people in intraday makes money, but there are few aberrations. One of them, I think a lot of people follow Jay on Twitter. I think he has been fairly, uh, what do I say, frequent in making money. But again, I don't know his portfolio, so I can't comment on them. But I have heard from many people. So okay, let's keep my market views away from this. The point of this webinar. We can do that conversation besides the webinar. In my method, you are saying that we'll become short-term investors and long-term investors. Well, that's not true. So, I mean, I'll give you a rough idea as to the way I do it. My average holding period for companies is 4 to 5 years. This is average, okay? But you have to consider that my investing experience is not 25 years. So when I say that, I am saying few exceptional cases I have invested for 5 years. But my whole investing experience is only 8 to 10 years, considering where do I think it started. Same question, I mean, with this much knowledge by investing little capital. Start investing once you know, once you feel you're ready to invest. I'll do one thing. These kind of questions you can do, drop me a mail. I can probably, reply to you. I'm not really sure if we have time to do these many detailed discussions. As far as the Twitter ID is concerned, my Twitter ID is this. And in case you guys want to drop me a mail, I am very slow with replying on mails, but or it's better that you can ask me questions on Twitter only. I can probably reply there. This is the website. Okay, so I think it's one already. Anything else? You can ask me all the questions on Twitter. I can reply there, or you can, in the comment section of the of the website, wherever you feel possible. So I think that's it from my end today. I hope you enjoyed. I hope you liked the framework. I really hope you use it, because otherwise it's a waste of 1 hour, 2 hours for you.